All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I want to go out and take a look at with you here at the economic and earnings landscape of the current market because I think it has a lot to do, not a little to do, but a lot to do with what will happen going forward. And keep in mind, there's a wall of worry out there that is, high. Uh-oh, China this, China that, China, this and that and all of that, right? There's so many stories out of China right now that to put them all together, great. We have the Saudi Arabia, Turkey, U.S. situation. We have Italy and the ECB. I mean, Brexit, which, obviously is finally hitting the back pages instead of the front pages. We have a trade war and tariffs. We have Trump tweets. We have, what about earnings season? What's going to happen? We have rising interest rates. We have, is the Fed going to tighten too much? We can keep on going. The wall of worry right now in the market is arguably higher than it has been in a very, very long time. That's nothing unusual. That's nothing abnormal. That's nothing where you go, oh, man, this market's just crazy. No, it's a normal market. These things are very normal in a market. And it's nice to see some of this normality, here. And generally, when we go through a period where the wall of worry skyrockets, everybody's worried about, okay, what's the next meeting with the Fed and what's going to happen with Italy and what's going to happen with, Saudi Arabia, and what's going to happen with China and the trade war. But most times, you think about a few years ago, Russia and shooting down the Ukrainian plane and moving into Ukraine. You think about some of the upheavals we've seen in the Middle East. You think about some of the issues with Venezuela. You even think about Brexit and those issues that happen. They come and they go. They all come and go. And they all create waves in the market. Some would argue that the market is driven by them. But the evidence, the empirical evidence, suggests that all they do is create waves. That's all they've ever done, and that's all they probably will do, is create waves. Why? Because none of those really affect economic growth. And when it comes down to it, the long-term of stocks, they move on economics and they move on earnings, which are closely related. And so when we look at a pullback in the market, when we look at a slide, and even though there's a massive wall of worry and a massive wall of concern, does it mean that, hey, you know what, all of a sudden the market, it's overvalued, it's just going to go down, down, down like, most people will argue? Or is it a buy opportunity? You can't figure that out by looking at the wall of worry. You can't figure that out by trying to understand more about China, by trying to understand more about the Turkish, Saudi, U.S. situation. It doesn't matter how much you analyze and look at those. You're gonna miss the forest for that little tree. And the forest is the economics and the earnings. Now, unfortunately, in the market, you can't always tell what the earnings and economics landscape is by looking at the reactions, right? Some people would say, hey, the economic situation is getting a lot worse right now because the market's been going down and the market reacts to the economy. Oh, really? Is that why the market's going down? Economic concerns? Well, just look at Caterpillar today. It's down $12. Those earnings must have been terrible. Really? I mean, AT&T was down 4% on their last earnings, 5% on their last earnings. Never ticked lower. Looking at the reactions doesn't do it justice. Reactions are fear-based, greed-based. They're the emotional part of the market. But if we're going to look at this current market, we better understand what the economic and the earnings environment is if we're going to get the next major leg here on the market. And I would argue with you that the market's going to go set new highs. I've made that argument for a while now. And, we talked about the pullback, and we talked about, hey, chances are we test new lows in the short run. And, we could still set new lows in the short run, even though we did hit new lows briefly today. But I don't think the market's out of the woods in terms of the pullback. But I want to go take a look at it and show why the market's going to set new highs at one point going forward. This is a very similar situation to back here in 2014, where we had Ebola, we had some earnings concerns, we had some Fed concerns. They all kind of came in at once. There was kind of they all kind of formed together and fed on each other. And was Ebola solved by the time the market bottomed? No, Ebola was kind of finally figured out up here. Was, the earnings situation totally different up here than down here? Not at all. It was the same earnings situation. Did the economics change dramatically? No, it was the same economic environment. And that is the consistency of the market, is that it reacts to earnings and essentially corporate profits, which some would argue are the economics. So let's go take a look at both of these. We're going to use two sites. One is called FactSet. All right, one is called FactSet. And, if you type in FactSet Earnings Insight, every week they put out this, this kind of nice summation of the earnings season that just helps you see some of the key metrics. Okay. And this was released on Friday with 17% of the companies in the S&P 500 reporting. And you say, well, 17%, we're missing 83%, so is it going to really show us what's going on? Well, yeah. By the time you have 17 to 20% statistically, you're not going to see much change after that. You have the model in there. You have the overall element here, and chances are, yes, there are going to be a few numbers that change here and there, but chances are the general numbers stay the same. And they're going to talk about earnings growth, earnings revision, valuations, revenues, and so let's go take a look. Q3 earnings season by the numbers. For Q3 2018, more companies are beating estimates than average. But the magnitude of the beats is smaller than average. In terms of earnings, more companies are reporting actual earnings per share above estimates compared to the 5-year average. In aggregate, companies are reporting earnings that are 3.9% above the estimates, which is below the 5-year average. In terms of sales or revenues, more companies are reporting actual sales above estimates compared to the 5-year average. In estimate, aggregate companies are reporting sales that are 0.5% above estimates, which is below the 5-year average. So what are they basically saying? They're basically saying, look, companies are beating on earnings and they're beating on revenues at a higher rate than normal, but the magnitude of the beats are not as great as what we've seen over the last 5 years on companies that beat. So we're getting more companies that beat, but the beats aren't as good. And if you look at the reaction to stocks on earnings, even on the real positive earnings, we're not seeing as positive of reactions, with that. The blended year-over-year sales growth rate for the third quarter is 7.4% today, which is above the sales growth rate of 7.3% last week. Positive revenue surprises. We have revenue growth out there year-over-year of 7.4%. I mean, we continue to be coming out of a revenue recession. And we continue to see some strong revenue growth, in the market. Okay, analysts see double-digit earnings growth for the fourth quarter, but also see single-digit earnings growth for the first half of 2019. Forward PE ratio is 15.9, which is below the 5-year average, but above the 10-year average. So valuations of the market have definitely gotten cheaper, right? Market sold off. Valuations got cheaper. That's pretty easy to see. But, if we take a look, you can come in, you can kind of take a closer look at a lot of the numbers and what they look like and how they are looking. But bottom line, earnings growth, 19.5%. If this is the growth rate, the final growth rate, it'll be the third highest growth rate. It's a massive growth rate for earnings. I mean, almost 20%. That's a massive number. Now, of course, we're probably not going to see 20% growth rate in earnings next year. So there's going to be some concerns that, yes, the growth rate will still have high growth rate, but the growth rate won't be growing, right? But we have double-digit earnings growth, by a lot of sectors. Banks, 22% earnings growth. If you look at the bank reactions to earnings, I mean, banks have been falling like rocks. 22% earnings growth. Revenue growth. Here we are, 7.4%. We see really strong revenue, really strong earnings growth, going forward. Here is the concern. The 2018 earnings growth estimate is 20%, but 2019 earnings growth estimate is 10%. Going from 20% down to 10% is very different than going from 10% up to 20%. Those are two very different ball games. When the growth estimate and growth rate is going down, right, when it is falling, even though we're growing, when it's falling, it creates market concerns. It creates concerns that is that trajectory going to continue, and are we actually going to go and see a recession? And that's what the market's dealing with right now in terms of earnings. That's one of the big angst here for the market in terms of earnings. And that's one of the things that the market is pricing in. And it's pricing that in based on the fact that we haven't seen analysts really upping their estimates going forward. We haven't seen them really, kind of changing them because of some of the concerns and some of the worries that are out there. But that is the concern. That's the kind of the hot button, point here. Okay, so we see overall, and I don't think there's another chart I want to show you. You can go through this if you'd like. But, we see overall the numbers are fantastic. But the look towards the future is the concern. Well, that's normal when it comes to earnings. That's, that's nothing unusual. That's nothing abnormal. But we have kind of some record earnings in several key ways here. But that outlook going forward, what's that tell us? Well, that tells us that there's uncertainty. There's concern, right? That tells us that stocks in the future are not going to be as desirable as they are now unless something happens to increase the expectation of the growth rate. Okay, so if something happens to increase the expectation of the growth rate, all right, what's that mean? Well, if we get an uptick in economic data, some sort of resolution to the trade war, Saudi Arabia, Turkey, Italy, who cares? No offense to those countries, but who cares? Those have nothing to do with growth. They have everything to do with little ripples and waves in the market. But China does have to do with growth. What Caterpillar says does have to do with growth. And so this market right now is kind of in this period where it's looking and it's saying, hey, growth rate's not going to be as good. Yeah, I know stocks are cheaper now, but are they worth holding? This is really worth holding right here. And so investors are going to need some sort of catalyst, something to make them feel good that, look, earnings growth is going to be better than expected. And what have they had lately? They've had the Fed pounding the table. Fed, we're going to keep raising, blah, blah, blah. We're going to monitor and everything else. But basically saying, look, we're still on track to do what we're going to do. And we're not too concerned that the growth estimates are going to go down. And that growth is going to go down. Because for them, it's putting it into a little bit of normality. So if we just look by the earnings landscape, We can make a pretty decent bullish argument. We could take a pretty decent bearish argument, right? And either way needs a catalyst. Definitely needs a catalyst. But if we go to look at the economics environment, we could put the earnings environment in a little bit more perspective. And let's go to a different site. I'm going to go to tradingeconomics.com. And this is, if you're an economic nerd, this is fantastic. Just absolutely fantastic. This is data. But let's go look at the story. And we're just going to look at U.S. data right here. Now, we could go do this with other countries and it'd be a little bit different. But let's just go look at the U.S. And let's go look at the economics here. Let's start with the biggest one that everyone looks at, GDP. GDP, gross domestic product. And, is the gross domestic product, which is what, general consensus uses to look at economic growth, is the gross domestic product rising. And the GDP growth is up here around 4%. It's one of the highest GDP growth rates that we've seen in a long time. 4.2% in the second quarter. We'll see it dip back on down, right? And, if we look at the annual growth rate, we're going to get a little better picture, better perspective. But the annual growth rate is almost up here. It's about 2.6%, right? That's one of the high, this is at the high side of what we've seen in a long time. So if we continue to see the economy growing, what's going to happen to those earnings estimates for corporations? Yeah, you got it. They're going to have to be taken up. They're going to have to be taken higher. In the same way we've seen quarter after quarter after quarter as the economic environment has risen. Now, the big problem with GDP is it's a lagging number. You don't get the actual full picture of GDP until 3 months after the quarter. So for traders, who cares about GDP? Well, let's go to something that actually matters, right? Let's go take a look at prices, because if the Fed keeps raising rates, why are they doing it? They're raising rates because they're worried about inflation. So is inflation getting out of control? Right? Is inflation getting, to a crazy level here? Well, here's the inflation rate. We're just over 2%, right? You can see the inflation rate ticked up to 2.4%. And the Fed has been raising rates as inflation has been going higher to combat it, right? Inflation itself isn't bad. Inflation is generally, you need inflation to get economic growth. One of the reasons why the Fed wasn't raising rates back here in 2013 and 2012 is because inflation was under 2%. But now we have inflation up here. That corresponds with the economic growth. That's a very normal metric, very normalized. We're not seeing anything abnormal that would suggest, some sort of major type of meltdown. Let's take a look at money. Here's money supply. I show this to you just a little bit as a curiosity, but there's an argument out there that, the market shouldn't be higher than where they were in the 1980s or in the 1990s or even in the 2000s. And man, we got to go back to levels seen in 1987 for some reason, right? When they just look at stocks. But one of the things that's forgotten in those arguments is the fact there's just way more money in the system right now. Let's just say everybody in the U.S. was given $100,000 tomorrow. Everybody was just given the same amount of money, $100,000 tomorrow. Everybody got it. Would prices really, would you really be richer? Would you really be more wealthy? You'd have more money, but what would happen to prices of everything? It'd all go up. Everything would go up equally, theoretically. So things are going to cost more. Yeah, you have more money, but things are going to cost more. One of the things in the market, in stocks, yeah, they've gone up, but so is the money supply. Right? There's just more money in the system, so the natural pricing is going to go up. It's one of the big reasons why to say, oh, well, we're going to go back to 1980 levels is ridiculous. You need to see a huge contraction in money supply, or just something where, that made the stock market worthless. Whichever metric of money supply we want to look at, we're going to see the same thing. And I won't bore you with the details of the differences between the different money supplies. But, bottom line is the supply of money is at all-time high levels. And that's generally what we see when stock markets hit all-time highs. And, we continue to see the money supply on the rise here in the U.S. All right. Those are all interesting things, but those aren't really what the market's worried about, right? They're not worried about GDP. They're not worried about inflation. They're not worried about money supply. What are they worried about? They're worried about trade. Imports, exports, what's going on by China? Well, let's take a look. Here's the export data. Over the last 10 years, over the last couple months, exports have ticked down a little bit, right? They've ticked down a little bit, but we are near all-time highs in exports. What about imports? They have continued to tick on higher and continue to sit here at all-time highs. So imports, exports, still very high, still growing. Well, what about what about with China? Well, take a look. Here we are with the import numbers. The U.S., what the U.S. imports, and they import 19% from Canada, 16% from Mexico, 8.6% from China. Look at the export numbers by country. Or excuse me, the import numbers by country. 22%. See the trade gap? 22% of our imports come from China, where nowhere close to that of our exports go to China. So this trade war, it's about closing that gap. But you see the huge it's a huge portion of trade. And so when people throw out, well, billions of dollars and this and that and this tariff and that tariff, yeah, they're big numbers. But in terms of the overall value of, trade, they're big, but they're not soul crushing. They're not soul crushing. And we continue to see imports, exports on the rise. Their trends be strongly higher, and even with the trade war now having evolved for 5-6 months, we continue to see those elements here. Let's go to perhaps one of the most important things: corporate profits. How much do companies make? Because ultimately, isn't that what the stock market's about? More profits mean the companies are worth more money. Well, look at corporate profits. They're at an all-time high. They've never been higher. They have grown sizably in the last 2-3 years. What did we talk about when we looked at the earnings? Well, we talked about the fact that, hey, those corporate profits, there might be some concerns that the growth isn't as strong. Look at what the growth has been, right? And so do we just go to more of a plateau type of period? Valid concern. Very valid concern, but overall corporate profits, they're up 25% in the last 2.5 years. It's a pretty hefty number. All right, well, what about, what businesses are actually doing? Are they producing? What are they manufacturing? Is manufacturing going on up? Yeah, manufacturing continues to be, in a very strong position. But perhaps one of the best gauges of manufacturing and the economy going forward isn't analyst estimates, isn't somebody's opinion, but actually new orders. Are new orders coming in? Because that's going to trickle down in a big way. And here we have new orders. New orders are sitting at a multi-year high. They have continued to grow. They have continued to grow substantially. Trade war, they've continued to grow. New orders continue to be on the rise. When so far, when we look at ISM data, we look at PMI data, we don't see weakness in new orders. We continue to see growing strength in new orders. That's a pretty dang good number. Well, what about the consumer? You know, the consumer makes up a huge portion of the economy. All right, the consumer's going to stop spending. They're slowing their spending, right? Here's consumer spending over the last 10 years. Any blip in the radar? Any sign the trajectory is going to go lower? No, not at all. Not at all. What about let's see, personal income, right? They can't spend as much if they don't make as much. Well, look at the personal income jump. Personal income overall continues to grow. Why? Well, taxes are down, right? That's one of the reasons we see the bump. But we see consumer spending, we see consumer income, on the rise and increasing nicely. What about debt, right? People get worried about debt a lot. They've been worried about debt. I mean, for many, many years, they were, debt. And yes, personal debt can be nasty and can destroy families, can do a lot of damage. But when you're talking about country debt, generally they just inflate it away, right? Go borrow $1 trillion today, and if inflation is 2% every year for the next 50 years, what's that $1 trillion worth? Not much, right? Many, many years ago, the U.S., they borrowed $50 billion. That was a huge number. What's $50 billion today? Drop in the bucket. So, in general, economies, they actually go up, they grow when they take on debt. That's just the norm, and that debt gets inflated out. Now, if you take on too much debt and you inflate too much, right? If you start inflating it 20% a year to drop the debt like we've seen some countries do, yes, there's a big issue. But if it's that 2% type of issue, not a big deal. But with households, it can be a big deal. Well, here's households' debt to GDP. Household debt relative to gross domestic product continues to drop substantially. So this isn't debt spending like what we saw in 2007, 2008, where there was just massive debt spending. Go max out cards, go home equity loans, all those types of things to spend. This is consumers in general, and I know it's not from top to bottom. It is definitely skewed towards the upper side, right? Towards the top 20%. There's not a lot of income equality here, right? But that's not the issue. The issue here is, do we see overall, that spending, and will that continue? Because that goes directly into the bottom line for corporate profits. So we've looked at the economy from a consumer standpoint, manufacturing, new orders, corporate profits, imports, exports, GDP, inflation, money supply, debt. Is there anything here to suggest that the global economy is about to take a big downturn other than just speculation over fear? Well, yeah, the global economy has to go down because China and the U.S., they don't get along. Is there anything in the data that suggests that if you don't have all those fear elements that always exist for one reason at all time? I mean, a couple years ago, it was Brexit, right? Brexit was going to take everything down. You look at it today, and that was ridiculous, right? Then there was Russia, then there was this, then there was that. There's always going to be something. But in the data, can we see anything that isn't, or anything where you go, wait a minute, that actually kind of makes sense? The only thing in the data that makes any sense of saying, you know what, we might be ultimately seeing a top ahead of a much bigger correction is the expected growth rates going into next year. Outside of that, it's pretty darn good. It's not too hot. It's not too cold. It is kind of in that really kind of perfection range. And so when we look at what's going on in the market today, and we look at how things are, transpiring and what's going on, there's a pullback. Definitely a pullback. We had a pullback back here. And back here, you can go back to the videos, made the same comment, that ultimately we will be going to new highs because the earnings and the economic environment suggest it. Ultimately, we will go to new highs because the earnings and economics environment suggest it. But do not underestimate how low it can go. Because the earnings and economic environment is just slightly different. It's just slightly, there's that hint of, instead of growth acceleration, like back here, where if you looked at what the earnings estimates and projections were, they were all higher, and growth was on the rise. Here we still have growth, but growth is on the decline. So still a growing environment, but a declining growth rate. And that could equal a more prolonged and deeper correction than what we saw back here. So I think that has to be taken into account. That has to be understood, and that has to be respected. But we will go into a period where the market finds a little bit of a bottom, and it will go through a period of muddy waters where it just tracks for many months in around the same levels. The chances of going V-shaped in terms of recovery are very slim, looking at the overall environment. It would need a catalyst. They would need a really, really strong catalyst for that to happen. A major tax cut in the U.S., major kind of quantitative easing in China. It would take something really big to create a V-shape, type of move. It would take, all the tariffs being taken down by the U.S. and China and, coming to, some sort of kumbaya moment, right? That's what it would take. If those things happen, yeah, we'll go V-shape. But let's just assume the normal. Those things aren't going to happen. The market's going to the economy's going to play out like it always does, and it's going to take time. And so we're going to spend a lot of time down here in this area before going to that new high. What stocks do you want to be involved with? What stocks do you want to be in? What sectors do you want to be in? What stocks have the best chance of making further gains? They're going to be stocks that have expectations of increased growth rates going forward. The Microns of the world will bounce. The Microns of the world will make moves up. But to new highs? No. No, they're not going to make moves to new highs when the market is at a new high. Not without some sort of major catalyst. Major kind of disruption there. It's going to be companies that have higher growth rates going forward. Your UTXs of the world. Your CSXs of the world. Perhaps one of my favorite, right? Yeah, finally correcting. Finally giving a pullback. It's been a while. Been a while. But you'll notice CSX back here. Yeah, that was a nasty pullback. And it took a little time. But it hit new highs well before the market itself. When you look at companies, you look at where some of the real solid earnings growth rates are and where some of the real solid numbers are. You look at a stock like JP Morgan. For me to expect JP Morgan to hit a new high before the market itself hits a new high can make a very compelling argument for that given the earnings. Now, does it mean you go buy JP Morgan right here, right now, and play for a new high? No, not necessarily, because there's still some short-term chaos. There's, there's still some bearish arguments that have to get flushed out here and everything else, right? But overall, This is one of those where, where we are going to see a select number of stocks go and hit new highs. Your Adobes of the world, they're going to go and hit new highs. Your Apples of the world, they're going to go hit new highs, right? These are companies that are not having, they're pulling back because of the market, not because of issues that they are having. And those will be the ones that, if you're looking to play a rebound, that are going to, rebound some of the best. One of the really easy ways, let's just say you don't want to go look at earnings reports, you don't want to listen to me, you don't want to, listen to anybody else, you just want to do your own thing, you want to understand, okay, which stocks are going to pay off better for you over time. One of the things you can do is look at the highs that were set before this sell-off. And I'm not going to go as far as to say, hey, wait till they break the highs and buy them there, and you'll be fine. Because I know what's going to happen. They're going to break the high. Someone's going to go buy a weekly option, and the stock's going to correct 5%, and they're going to go, oh, wait. But you go look at the stocks that corrected in February, January. You go look at the stocks that set new highs the quickest. So here's Apple. It set a new high here in March. Did it go straight up from there? No. But over the course of the next 6 months, who is one of the best performing stocks in the market? Apple. Companies that hit new highs the fastest did really, really well as the market itself went and hit new highs. Here's Amazon. Corrects with the market back here February, January, hits new highs within weeks. Yes, it's not immune to pullbacks and all of that, but can you find many stocks that did much better than Amazon as the market itself tracked to new highs? Not at all. So if you're worried and say, man, I got to bottom pick this market or else I'm going to completely miss out. I'm going to, be in alerts. I got to have my retirement funds and I got to put them to work. Well, okay, you can go bottom pick, sure. Fine. But these companies that hit new highs sooner than later when the market starts to rebound, meaning they beat the market to the new highs, they're going to be some of the best performers going into the beginning of 2019. And for the first 6 months of 2019, they will be some of the best performing stocks out there in the market. So if you don't want to worry about the economics or the earnings or any of that, just look at the price action. Just look at the price action. You're not going to get that read today. It's not going to happen tomorrow. It's not going to happen the next day. But as we get about 2 more weeks out, 3 more weeks out, we get into the Thanksgiving time period, the holiday, December, Christmas, Hanukkah time period, you start seeing stocks breaking their highs from before this correction. Those aren't stocks that are overbought. Those aren't companies that are doing something wrong. Those are the ones that fund managers are saying, hey, these are the stocks we believe in. These are the stocks we're going to keep buying as we go forward. And these are the stocks that are going to do the best going forward. Yes, they'll be your bottom picker opportunities. They'll be your caterpillars that are, way down and way down in the dumps, and they find a good value range, and they make a climb back to 140 or 150, right? But they're not going to be, that's not going to be the norm for these, for these names without a catalyst. But those stocks that hit new highs over the course of the next couple of weeks, those are going to be the stocks to buy. You can come in, you can easily find them every day. You just want to do a little bit of research every day. All you have to do is come into something like a predefined scan here in the free version of stock charts, and there's so many sites that have this. And just come into the new 52-week highs and click on it. Now, most of these aren't going to be bigger name stocks, especially right now. Here's McDonald's, right? Jumping here today on earnings. Verizon on this list, right? I wouldn't start doing it today. I wouldn't start doing it tomorrow. But in the next 2 weeks, you start seeing major companies pop up on this list. Those are the companies you want to buy going forward. Those are the companies that are going to do the best. Those are the companies that are going to have some of the lesser volatility, lesser chaos associated here with them. hopefully this helps. Hopefully it gives you some semblance of idea of what to expect going forward here in the market. I do expect the market to unfold in a very normal way, right? We've seen abnormal for 3 years. I expect the market to unfold in a very normal way, which is to have bigger moves up and down, a little more volatility, a little more uncertainty, a little more kind of argument about, this and that and the other. And the nice thing about that type of normal environment is that you can start to kind of see where some of the things are really kind of setting up, where they're starting to happen, and you can start to position yourself and to take advantage of that here for the rest of the year, and especially going into 2019. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.